Hi, this is Mark Wahlstrom, and I'm back with another look at the settlement planning and structured settlement profession, where today I'm going to be focusing on an issue I raised in my last video, which is why has the structured settlement annuity product seen a steady decline in production from a reported peak of $6.2 billion in 2008 to as low as $4.8 billion in 2012, and then to last year's production number reported at $5.5 billion. All of this shows at least stagnation, if not a systemic decline over the last 15 years. Now, I raise the question of what happened to that $1 billion in production that we used to have in the early part of the 2000s. And I'm calling it the lost $1 billion that seems as if it's now gone for good. Well, all you have to do is look at the sponsors of the Society of Settlement Planners, the SSP, who just had their annual convention last week in Colorado to get the answers to that question. Now, it's reported that 3 of the 9 annuity markets that write structured settlements were sponsors there, but that 6 trust companies and asset managers were also sponsors of the organization and the conference. Now, all you need to do is ask yourself if twice as many firms who are not advocating structured annuities are sponsoring the primary plaintiff planning organization, well, it's pretty easy to see where the settlement funds, which once went into annuity products, have gone. It's under new management, ladies and gentlemen, and that money is not coming back. Now, asset managers, some wannabe RIAs and trust companies, have stepped in and filled a void and are now diverting a substantial chunk of that lost billion into managed accounts, trust companies, trust funds, and other non-traditional products. I mean, really, all you need to do is look around at the names, the cases, and the business models of many of these firms to realize that that lost billion is being absorbed by these firms each and every year. It's simple math, and with plaintiffs largely controlling the decision process of where money flows in a settlement, this trend is probably going to accelerate, not decline. Now, as most of you know, I'm a big advocate of the use of trust management for funds that need to be liquid, or which need longer-term service and counsel to injury victims over time. There are certain things a quality trust company provides to a law firm or an injury victim and plaintiff that independent planners and structured settlement brokers simply can't provide. And therefore, they offer a very valuable service and have a real seat and place at the table here. However, I'm becoming increasingly concerned about the quality, sophistication, and the motives of many of the asset managers who are now targeting the settlement planning profession. You see, I'm seeing a trend toward people and organizations who have no use for the traditional annuity product, which guarantees tax-free income for life or for a set period, but instead are putting clients into managed accounts simply because it's easier for them to do and doesn't involve splitting a case with defense brokers or dealing with multiple annuity markets to get a bid. I've seen proposals that are 100% bond funds, others that are 100% stock funds, while others are being managed by RIAs who have little or no experience or sophistication in money management, have come out of the settlement planning profession, as well as trusts that are charging fees for management and also using load or commission products inside that trust as well, which is an additional charge. Now, all of this is done under the guise of settlement planning, when it is in fact simply investment and brokerage types doing and saying whatever they need to say to get assets under management and away from the traditional guaranteed structured settlement product that has been the foundation of this profession. In short, we now have a situation where the influx of asset managers, which was once a trickle, is now turning into a steady stream, and I predict will soon be a flood, as any firm can state that they're a plaintiff settlement expert if they simply write a check and join the appropriate association. That seems to be the way it's going. Now, settlement planning clients and injury victims are the most vulnerable class of clients that you can imagine. Most of these people have little access to professional advice, and they're making a major financial decision at the time of their settlement. The use of the structured settlement annuity has been and should continue to be a foundation of those plans for most people who can't afford market risk, or the selection of an inexperienced asset manager who might just be looking to build a book of business out of those assets. Those are risks they can't afford, and in my opinion, the decision process needs to be transparent and based on a fiduciary standard, even if that standard is not currently the law or standard which is applied to our professional services at this time. You see, as professionals working with injury victims, we need to demand more from the firms that purport to be offering services that don't include guarantees and come with ongoing fees, expenses, and risks that plaintiffs and their attorneys need to fully understand and consider before they make a decision. Well, look, I'll be back next week with a further look at the trust and asset management firms that have an increasing impact on the settlement planning profession. And I'm going to be looking at when their use is appropriate and what people should be looking for if they choose a trust company or an asset manager or a registered investment advisor, and they want to go that route instead of with a structured settlement annuity. I'm Mark Wahlstrom. I want to thank you for watching, and I'll see you again next week.